Sophia, please start.
Am I audible?
Yes, you are.
Okay. Shall we start?
Yes.
Good evening, everyone. I am Sophia Ahmed Said, Research Scholar, Department of Commerce, Government Arts College, Trivandrum, and I'll be hosting today's session. Welcome to the 6th week of our Saturday webinar series organized by Research Forum, PG and Research Department of Commerce, Government Arts College. Today's session deals with behavioral finance and the psychology of investing. Before we start the session, make sure your mic is on mute always. Now, I invite Dr. Abita MV, HOD, Department of Commerce, Government Arts College, Trivandrum, to address the gathering.
Good evening. It is indeed a privilege for me to introduce the resource person for the 6th session of our webinar series. She is Dr. Rajini B. Bhatt. She has 20 years of teaching experience and she's working as an assistant professor and research guide at PG and Research Department of Commerce, the Cochin College, Kochi. She has 32 publications in various reputed journals and presented more than 30 papers in national and international conferences. She has a research project sponsored by UGC to her credit. The theme of this session is behavioral finance and the psychology of investing. Hope you have a wonderful session ahead. On behalf of the Research Forum, PG and Research Department of Commerce, Government Arts College, I welcome Dr. Rajini B. Bhatt to handle this session. I also welcome all the participants to this session. Thank you.
Thank you, ma'am. Now, moving on to the most important part of the webinar. But before that, there is a gentle reminder, if there is any question or queries during the session, post them in the chat box and you will be answered in the question answer session. Also, a feedback link will be provided in the chat box at the end of the session. The link will be active for 20 minutes after the session. Without any further delay, let's hand over the session to our resource person, Dr. Rajini B. Bhatt, Assistant Professor and Research Guide at Postgraduate and Research Department of Commerce, Cochin College, Kochi.
Good evening, everyone. Thank you for a very warm welcome, Ravita Madam. And before I start with the session, I please on record my thanks for being invited as a resource person for your 6th webinar series talk. I am audible and my PPT is visible to everyone in the meeting. Okay.
Yes, ma'am.
Okay. Right. Thank you. Behavioral finance, an area which is said to be around 22 years old because recordically, behavioral finance is said to emerge from the year 2002 when the person who proposed the theory, prospect theory, it brought a new subject more into picture. Prior to the term behavioral finance, we had behavioral economics. So that which involved going back in the years 1860s. But it was recently when David Kahneman coined the term behavioral finance, do we people came to know about more about this particular area. And this is an area, I won't say it's a virgin area, but lots of researchers have been started to be undertaken in this particular area. And if I'm not wrong, uh, in 2021 itself in MG University, along with one of my research scholars, around 5 to 6 different scholars have started their research in this particular area. Now, why? So the new subject, emerging subject of behavioral finance is so important. Let's see. Let me start my presentation with this particular picture, right? On the first picture, kept on the left side, you can see two persons arguing whether the bars lying are 4 or 3. One person, from one person's point of view, he says it is 4, and another person's point of view says it's 3. But if we shift our point of view from the angle of two different persons, we can identify, we can understand that both the persons are right in their own places. Similarly, is the next picture, which shows you a person reading a particular number as 6 and another person reading the same number as 9. So I come to a particular conclusion saying that seeing is not believing, it's only seeing. This is something what everyone, if you are an investor, if you are a trader, if you are a speculator, if you are a participant in stock market, this is what which happens. You find a particular stock price rising, or you find a particular stock price falling. It has been showing, a particular stock price has been continually showing a bullish trend. You can't identify why the particular stock price is showing a particular bullish trend, but you suspect, you closely watch a particular stock or a share for some time, for some period of time, and finally you realize that yes, something is happening in this particular company, and it is because of this particular reason the stock prices are rising up. And at the same time, the same stock price is being watched by another guy who will understand, or who will conceive, or who will interpret the particular trend as a prequel to a bearish trend which is coming, which is to be coming in future. So the same stock price movement I can view as a bullish trend. Another person will view it as a prequel to a bearish. So what you see is not what you can believe. What you see is simply what you see, right? Now, with this particular opening stage, I start with my presentation. Now, why the subject, or why do we have to study the behavior of individual investors? I'm talking about individual investors in this particular session. Why is behavior of individual investors so important? Because sooner or later, you're going to make some sort of investment. If you make a particular investment and it turns out to be profitable, you consider yourself lucky. And if you are facing a particular loss, you feel yourself unlucky. You have made a bad decision and you feel that you could have avoided. You could have avoided the particular uh, uh, making a particular decision. You could have avoided that. Now, there starts the first rule in investment decision. You have to learn to recognize the circumstances which might lead to poor decision. If everybody excels in this particular rule number 1, everyone can become Warren Buffett, earning millions and millions from the stock market. But alas, we are not so experts in understanding the circumstances, and we remain mere mortals. And very rare, a handful of us becomes Warren Buffett's. And then once you understand to learn the circumstances which leads to poor decision, you avoid them, thereby making your investments better. Or you can stop yourself from making investment blunders. Now, I ask you a simple question. Can you identify this particular person? Okay. Pardon? Okay. Somebody has kept their mic unmuted. Right. So, this guy is a Nobel Prize recipient called by the name Eugene Fama. Any researcher who is pursuing their research in commerce or management or even economics will be very familiar with this personality, Eugene Fama. Yes, he is a propounder of efficient market hypothesis. Now, it was in the year 2013 he received a Nobel Prize in economics for propagating EMH theory along with two other persons. I'm coming to two other persons also. But in Eugene Fama, in his EMH, he stressed on a particular hypothesis, which is called the efficient market hypothesis, which states that markets are efficient, thereby leaving no room for individual investors to make profit because each and every share prices are fairly priced. There is no scope for making manipulation or arbitrage or anything like that because whatever information is available in the market is equally available and equally absorbed by each and individual investor. Thereby, the efficient market hypothesis stresses on informational efficiency, saying that the markets are extremely efficient and thereby investors act rationally. Now, what do you mean by investors act rationally? Rationally, in the sense, an investor, when he makes a particular decision, he places his decision on certain scientific judgments, the various calculations, what he has made, the research, what he has poured into a particular stock or a share price. So that's how the investors behave rationally, right? Now, this is another personality, a very reputed personality. Can anybody name this person? This guy is Robert Schiller. Robert Schiller, who, yes, who along with Eugene Fama and Hansen received a Nobel Prize in the year 2013. Now, what is so special about Robert Schiller? Robert Schiller argued that investors do not, yes, irrational exuberance, correct. So he argued that, Robert Schiller argued that investors do not act rationally. They behave normally. That's the term what they are using now. Behavioral economists use the term investors being acting normal. They do not say irrational, but they better say normal. So thereby the investors in whatever decisions what they make, they are driven by their emotions, expectations, etc. Right? That's the term which aggregates all these expectations, emotions, the various factors which drive an investor in arriving at a decision called by the irrational exuberance. He concludes that the stock market must be inefficient. Now, that's the beauty of awarding Nobel Prizes. In the same year, 2013, three different economists received Nobel Prize. Of these three, two came up with contradictory theories. Eugene Fama saying that efficient market hypothesis and markets are efficient, investors behave rationally, and another guy, the second guy, Robert Schiller, coming up with a particular statement that the market's irrational. He coined the term irrational exuberance, and he claiming that the markets are inefficient. That is, investors do not act rationally. So now we come at a particular dilemma. How can you call investors rational or irrational, right? And here I am introducing the picture of Warren Buffett.
Excuse me, ma'am.
Yes.
Yeah, ma'am, can you please share the screen fully, ma'am? Can you please share the full screen?
Okay.
Thank you, ma'am.
Right. Is it done?
Thank you. Thank you, ma'am. Thank you so much.
Yes. So making the so we arrive at a particular question. Are the investors rational or irrational? Now, place yourself in a particular situation. Forget about how you're going to behave when you're going to buy shares or stocks or anything like that. And just imagine the situation where you're given an amount of, say, 10,000. Now, with the money, the bonus money, what you have got, the gift, what you have got, you make different sorts of plans. This is how I'm going to spend the money, what I have unexpectedly got. I'm not going to invest it, I'm going to spend it. Now, this is how I'm going to spend. One at one particular moment of time, you make one particular plan. Immediately, the plan is replaced. After 1 or 2 hours, you're having a second thought, and you come up with a plan B, the another way of spending money. Then you have plan C. Then you find your friend purchasing, coming up with a special electronic equipment. You want to buy that. You immediately forego all the earlier plans what you have made, and you come to a conclusion that this is how I'm going to spend my money. And finally, the question is, how do you actually spend the money? See, that's the question. How do we actually see earlier standard traditional finance theories were based on lots of assumptions which were actually not present in the uh, current scenario. Yes, that's how the new subject called by the name behavioral finance has emerged. Even though the markets were said to be efficient in all traditional finance theories, we find that certain market anomalies. That is what we call market anomalies. Markets find there are certain deviations or distortions which happen in stock prices, which cannot be predicted by any economist or any expert on stock prices. So you find different types of market distortions. You call it by the name market anomalies that makes you that make you question the particular assumption. Are markets actually efficient? Then you find that during certain times excessive volatility in the sense, I'll tell you, in case of derivative market, in case of F&O segment, every Thursday is a closing day, and every Thursday is the day which you have to be, if you are an individual investor in F&O, which even SEBI nor I advise you to be, but still you find many individual participants in F&O. If you are going to you close a particular position on Thursday, you have to be very, very, very cautious, because that's the day either you can win a lottery or you can lose whatever money you have, because that's called Thursday, closing day effect. Immediately next Friday, the complete different scenario evolves. So there is excessive volatility in between. There are weeks, there are days when you don't find any trading at all. The market appears to be dead, completely dead, which is not at all good for the participants in the market. You require some sort of movement, some sort of volatility in the market. So there is excessive volatility during certain occasions, and the market appears to be coming to a standstill. So that excessive volatility, and when there is excessive volatility, there is excessive trading, and similarly, there is complete overreaction and underreaction to any good news or bad news what emerges about a particular company. And in 1980s, Wormer de Bond coined the term behavioral finance, which was later on followed by propagation of prospect theory by David Kahneman and Tversky. Now, this is the guy who is Thursday effect. Can it be called as an anomaly? There are many studies which have taken place on studying whether it is Black Friday effect or Thursday closing day effect or the last hour trading hour
मैंने ठीक किए
effect.
उसके और जो ऐड करना है साक्षात का अनुसूची वो मैटर है आपके पास अनुसूची साक्षात
Hello, am I audible? Yes.
Yes, ma'am.
So it depends on the objective of the study what you are pursuing. There are different anomalies what you find in the market. It may be like you find a particular price of a share underpriced, low to book price value. Many anomalies are there. So it is. I don't feel that it is wrong to say that Thursday effect is not an anomaly. Right? Any distortions what you find in the market can be termed as anomaly. Now, this is the guy, David Kahneman, who is called by the name father of behavioral finance. Now, along with his companion, Vernon Smith, he propagated the theory called by the name prospect theory. Now, what is prospect theory? The prospect theory, or it is otherwise called by the name loss aversion theory, is a psychological theory of decision making under risk conditions. Risk condition, it states that while choosing, while making a decision before making investment, you tend to weigh loss more than what you expect in gain, right? Now, it says that decision making involves a source of trade-off. Now, investors are much more distressed by prospective losses than they are happy about prospective gains. Now, for example, if given an option on deciding on decision making whether to invest in a particular share or not, if I feel that I am going to lose $1 in this particular investment avenue or investment opportunity, I'll think twice than deciding whether I'll be gaining $1 if I invest in this. Because in case of a normal individual investor, it's like we tend to weigh more of our loss what we can make than the profit what we can make. So in that particular case, investors tend to be risk averse with regard to gains, but they are willing to take more risk when it comes to losses. I'll explain the theory with the help of a diagram. Now, continuing with loss aversion theory, it states that people make decisions based on potential value of losses and gains rather than final outcomes, right? Basically, it comes to a conclusion that loss aversion refers to people's tendency to strongly prefer avoiding losses than to acquire gains. When I make a particular decision, I try my max to avoid losses than I am intending to make gain. Now, again, I come back to that contradictory question, are markets efficient or inefficient? Now, economists say that the various studies say that the three conditions must be absent in order that the market is inefficient. One is investor rationality. That's the first assumption of a standard finance theory, EMH. EMH says that investors are rational, and we find in many cases investors do not behave rationally. We do our research, we do our expert opinion, we do our scientific calculations, everything. We do technical analysis, we study about a particular stock and a share, and how do we act? We do not act. Most of the cases, we do not act as how we are expected to act. So there is investors do not act rationally, and then you find the independent deviations from rationality. That's the case of market anomalies, and there is arbitrage. You can trade between two markets, thereby you can make a profit. Now, if these three conditions are present, markets are said to be efficient, and the absence of these three conditions makes a market inefficient. So, in real world, what we find coming out of the assumptions and what do you say, a world which do not exist, we find that investors make irrational investment decisions, and collective irrationality of these investors either make the market very bullish or it makes the market very bearish. Thereby, this situation cannot be corrected by even by rational, well-capitalized investors. Now, whether these conditions can all be absent is a question of debate. Now, here I come to the subject, behavioral finance. Cognitive biases to prospect theory. Cognitive biases, we have lots of different types of cognitive biases which are dependent on prospect theory, is it not? So definitely, in my opinion, cognitive biases can be related to prospect theory. because we are coming to cognitive biases, we discuss the different types of cognitive biases what we have, and we'll come to that. Now, behavioral finance is an area of research that attempts to understand and explain how how reasoning errors influence investors' decision. Much of behavioral finance research stems from the research of psychology, cognitive psychology. Yes, it depends on behavior, emotions, and thought. So that's all a part of different types of bias. I'm coming to that. Now, cognitive psychology, it says reasoning errors. It is like you have different types of reasoning errors. I'll be explaining all those reasoning errors. To continue, behavioral finance is the study of investors' psychology while making investment decisions. Now, behavioral finance being a very new area, a sort of, literally a sort of virgin area, research studies, the researchers which have been conducted in this particular area says that you have different types of biases like emotions, fear, overconfidence, greed, etc., which influence investors' behavior, and ultimately it has an impact on stock market. Thereby, it calls for a need for studying the behavioral finance, the area. Now, this is the definition of behavioral finance. In the words of Daniel Kahneman, he says that psychology has a story to tell about investing, and it is different from what the story economics tells. Because in economics, we study different theories, but the question is, do we actually find the applicability of all those theories in practice? So that's where the concept of psychology sets into this picture. And hence it's a combination. It's a study of influence of psychology on behavior of financial practitioners. That's how behavioral finance is defined. So this is how the evolution of behavioral economics has come, right? You have different behavioral theories, yes, I'll be answering to that particular question also. In fact, we cannot connect standard finance theories, traditional theories with behavioral finance. We can just study, compare and contrast between the two. And coming to them, you have different behavioral theories propagated over years, which comes to a conclusion that economics plus psychology arise at a new subject called behavioral finance. Now, these are said to be the four main characteristics of behavioral finance. You have heuristics, you have framing, you have emotions, and you have market impact. The first one, heuristics. Without listening to this particular term, you cannot go ahead in behavioral finance. What do you mean by heuristics? Sort of shortcut methods. The method of taking decision, day-to-day decision, how we take, the rule of thumb. Whatever little decisions, whatever little information we have gathered, immediately we come to a conclusion. So the information what we have gathered may be insufficient, incorrect, or it might not be reliable, but we are not checking any authenticity of the information what we have collected. Whatever information what we have, we immediately tend to come to a particular conclusion. Like that's how what we have been doing. So we'll be continuing doing the same thing. All our day-to-day decisions depends on the heuristics, the way how you take your decision. Framing. If a picture of half glass of water is shown to you, a glass of water with half filled is shown to you. It depends on how you view it. Some persons view it as half filled, and others feel it as half empty. So that's how you frame a particular question. See, in research, while framing a questionnaire, most of the researchers, what they do is what knowingly, unknowingly, consciously, and subconsciously, what happens is, if it is the answer what you need to get, yes, that's the first option what you suggest, and that's how you frame the question. The next star teacher is absent, right? Yes. So you won't say the next star is not free to us. You'll never frame a particular question The same rule applies to a particular decision-making question. Whether you want to make a particular decision in terms of profit or in terms of loss. So that is frame dependence, framing. How you look at a particular question, how a particular question is framed, whether it is in terms of mean variation or expectations or profit or loss or yes or no, positive answer, negative answer, it depends on how a question is framed. It influences your answer. So that's framing. Emotions. Obviously, a man, Keynes have used the term animal spirits. Animal spirits in the sense human beings are social animals. So obviously, we have lots of animal spirits in us. It's like you're driven by greed, fear, overconfidence, uh, different type or whatever. You have different types of conflicting emotions. Basically, you have primary emotions, you have secondary emotions. Primary emotions are like love, fear, the basic emotions what we display, and secondary emotions are something what is derived from. So you have different types of emotions, and whatever decision, there is a small. I won't say small in my case and all, and I consider myself a very normal individual, a very normal investor. Emotions play a huge role, and then you have market impact. Market impact, how you perceive a particular market, whether you look it as a bullish trend, you have been closely following a particular share for some period of time, you feel that the price is going up, so you perceive that it is a bullish tendency which is coming up, and then you have the same picture is viewed by another person. You know how movie reviews come up. There are certain movie critics who award 5 out of 5 rating for a particular movie, and the same movie will be reviewed in 2 out of 5 by another critic. So it's how you analyze or you read a particular effect. Now, behavioral finance has got two branches. You have micro behavioral finance and you have macro behavioral finance. Micro deals with individual investors. Irrational investors are compared to rational investors. Standard finance theories consider investor as a rational economic man or homo economics, whereas behavioral finance economists do not consider investors as rational. They prefer to say investors as normal. Now, you have macro behavioral finance, which deals with corporate sector dealing with efficient market hypothesis. Now, I quote in words of Benjamin Graham, the investor's chief problem and even his worst end is likely to be himself. Right? Why I say so? Because there are 3 factors that influence the market: fear, greed, and greed. Now, I'm going to substantiate the first saying with the help of this particular picture. While I was preparing PowerPoints for this particular session, I came across this particular graph, which I could not leave because this is what happens in case of an investor. As a person hailing from Kochi, Matanjiri, which is considered to be one of the place where you have lot of investors, traders, speculators. We in Kochi, Matanjiri have got World Pepper Stock Exchange, for the first MCX to be operated. I come from that particular community, and I'm not a Malayali, even though I'm born and brought up in Kerala. I am very familiar with the language. I'm not a Malayali. I come from another trading community called Konkani. And here in my birthplace, I'm surrounded by, you have a lot of Gujaratis, you have a lot of North Indians who are basically into trading. So this particular graph, I could identify. And in my house also, there are many persons who trade. So evening time, every day, evening time, the conversation revolves around how the market was today, how this particular share reacted, why this particular share had a dip, or whatever. Almost 90% of the conversation revolves around this particular stock market, and this is the graph, which I could find reflecting in each and every one of the investor whom I know. I do not invest. I'm not an investor. I'm an investor, but I'm not a speculator. I have invested money, but I do not engage myself in day-to-day trading. Maybe the reason is this. Now, see, I'm an individual, and at first I find is I see a trend. I am closely watching a particular share price, which has been going up for some time, and I find that yes, this is a price-winning, a profitable investment avenue. I watch it closely. I watch it closely, and I find that the market, the price has been going on rising. It has not till now shown any deviations or distortions or any bearish trend. The price of this particular share has been moving up. So at a particular point, I buy because I find that if I wait any longer, I'll not profit from the trend. So I buy. And after once I buy, I find, oof, thankfully, I didn't wait to buy because the price is still going up. Now, then there comes a time when the share price takes a huge dip. You do not know the reason why the particular share price is dipping, because the market, generally the economy has got a positive trend, but still the stock the share what I have purchased has shown a dip. But still I wait. What I do is that I had purchased the particular share at a very high price. Now, when the price comes down, I buy more. Thereby, I can better improvise my position while taking average. The cost of my cost price will come down, right? And with this particular intention, instead of selling it, I buy more. So my perception at this particular point is I use this correction to increase my position and I buy. Now, again, the price is showing a dip, a downward trend. And I'm of the opinion, wow, at this price, I'll double my position because I'll double more so that my cost is less. So when I average the cost price of all the shares what I have purchased at different prices, my cost price of a particular share is coming less. So I'm happy now. Now see, I can't believe the price has now come to half. This must be absolute bottom. I come to a conclusion, but no, the price keep on falling. Now I start to blame all other regulatory authorities. Why is the SEBI not taking any particular action? Why is the Banking Association not particular taking any action? And finally, I have enough of waiting. I have enough of patience. I have faced a huge amount of loss. And finally, I say, enough is enough. Now I should sell. And I sell when it is at rock bottom prices and I have made such a huge loss. And finally, again, the price goes down. I console myself saying that luckily it was good that I sold it yesterday or day before yesterday. Today the price is again come down. And then immediately after I sell, 1 or 2 days after, the price of the share goes up. This is what happens in day-to-day market in case of individual investors. So what happens in this case is the price of the share goes up. I'm still watching the particular share, and then I come to the conclusion. Again, the price goes down. I'll say, see, this is what I said. No, I knew this was going to happen. That is another sort of bias. We'll come to it. Then immediately the price starts going up. And finally, it comes to the particular point where I had purchased the price. And even though I have faced so much of loss, I still buy the same price at a higher price, thinking that anyway, and whatever, I'll buy it again. Anyway, it's cheaper than the last time, right? So this is the graph. This is the roller coaster ride of emotions. When in case of a normal individual investor, this is what happens. Now, this is why we need to study behavioral finance. It helps you to understand the reasons for market anomalies. It helps you to identify investors' personalities. It helps you to identify whether a particular investor is risk taker, risk lover, risk averse, or risk neutral. It provides an explanation to various corporate activities, and it enhances the skill set of investment advisors. Now, most people know that emotions has got an impact on investment decisions. Investment decision. What is the source of this diagram? I had listed. Yes, it's not visible over here, but I'll be sharing the PPT with the post so that you can take it from there. And below, I had given you the source of this particular diagram. 2015, a study was done, and the Credit Suisse, that's the annual report. So people in industry commonly talk about greed and other expectations while investing in stock market. So behavioral finance extends this analysis to the role of biases in decision, how decision makings are done. Now, this is the comparison. This was what I was telling you that we will be definitely doing a comparison between standard finance theories and behavioral finance. Standard finance theories assume that people process data correctly. Each and every individual investor has got that aptitude to correctly analyze, correctly interpret the data, the information what they have received. Whereas it is not so. If this is the case, why do some investors make huge profit from the same opportunity, others make a loss, and others stand neutral? So it's how it's not that they process the data correctly. If an information is available, it is information available to everyone, each and everyone, but it is the way how you interpret it. So the first assumption that people process data correctly stands invalid. The second assumption in case of finance theories is the people are driven by logic, reasoning, and judgments. The various judgments you arrive at after making huge calculation, after reading so much of economic reviews, after watching so much of TV shows, taking advice from expert analysts and all. And then the markets are said to be efficient and it assumes risk return transparently. But complete contradiction we have in behavioral finance, where people process imperfect rule of thumb. The same situation will be given to different investors, and all the investors will be behaving in completely different way. It is not how I see. It's like I can't stop myself from giving an example in this case. 20 years back when I had started with my teaching career, one of my professors had asked me, had told me a story. In one day, you have 5 hours in college. The same students, but teachers are different for all the 5 hours. So there was a group of naughty students. What they did was they behaved in the same way in all the 5 hours in all different teachers' classes. Yes, in different classes, they all behaved in the same way. They wanted to analyze the what is the response or the reaction of a teacher to a particular act. It was how they judged the teacher. It was like whether this particular class is worth attending tomorrow or not, depended on how the particular teacher reacted to a particular situation. Right? So people process imperfect rules of thumb. I will be reacting to a particular situation in a completely different way than the other person. Other person, like, he is complete different personality. So same is the case with investors. Investors behave differently. In a same situation, each investor behaves differently. And each investor, almost each investor, is driven by emotions and herd instincts. Yes, hope is also a primary instinct, what you can say, like fear and greed. Hope is also a primary instinct. Then you are driven by emotions and herd instinct. That is another term what is very widely used in behavioral finance, called by the name herd behavior. Herd behavior, we want to be, as an individual, we want to be accepted by the society. So even if you are not so sure about a particular practice, you do not want to deviate from the society. Everybody has been doing it. Chalo, I'll also do it. So that's that behavior. It takes lots of courage and a lot of willpower and a little bit of eccentricity to stand away from the group. It's like, this is not normal. This is not logical. I'll stand away from it. I'm not going to follow this procedure. Immediately, that particular person will be viewed as a specimen, as if, why is this person doing, not doing whatever others are doing? So that's that herd instinct. And markets they are not completely inefficient. They are somewhat efficient, right? And it assumes the risk return under frame dependence, how a particular question is framed. Now, coming to the next part of the presentation, I come to bias. Now, what is bias? Bias in the case, it is the way how you react to a particular situation, right? It is how we view a particular situation. It is how we interpret a particular situation. So bias can broadly be divided into two. You have cognitive bias and you have emotional bias. We are here talking about cognitive bias. Cognitive bias, you have a list of cognitive biases. You have overconfidence, you have representative bias, you have anchoring, adjustment bias, you have cognitive dissonance, availability, etc., etc., etc. And at the same time, you have emotional bias also. Now, how you make cognitive bias or how cognitive biases influence your decision making gives rise to a particular subject called by the name behavioral finance. Let's analyze each one. Let's analyze one by one the behavioral bias what we have in the picture. We start with overconfidence. Overconfidence, it's always like, I'm correct. Now, this is one particular characteristic feature what you can find right from our child. Whenever your parents correct your behavior, it's like, no, this is what correct. And whatever I'm doing, I'm thinking, my way of thinking is correct. So it can be confidence or it can be overconfidence. A very narrow difference exists between, a very narrow line of distinction is there between confidence and overconfidence. It's like, yes, I'm well prepared for the examinations. Some might read it as confidence, others will be reading it as overconfidence, right? So investors feel that, yes, I know everything and I'm capable of making all decisions in an expert way, and I'm not, I'm better than any experts what you have in TV or on any of the social media who sit and give their opinions about any of the upcoming issues. The second bias is representative bias, or it is otherwise called gambler's fallacy or Monte Carlo fallacy. Now, what is this? This is like, if a particular event continuously takes place, more are the chances that the event will not happen. You're a gambler. Now you feel that you have been losing for some time. You come to a conclusion that I have been losing for some time. Definitely, I'll win next time. So that's the representative or gambler's fallacy. You predict, investors usually predict performance of an IPO, relating it to the previous. The IPOs what have been coming in this particular season has all been oversubscribed. So obviously, this particular IPO also, when it comes, will be oversubscribed. Right now, you have LIC IPO coming up. A huge hype has been created. But at the same time, there is a parallel talk going on between the experts that the price what is being offered during IPO, the LIC shares will be available at a price lesser than that. Now, that's a parallel opinion which is running with this IPO. Now, the question is whether this IPO will be accepted by the public, oversubscribed, or it will be fairly subscribed, or what? Now, that's a question what we have to look for. You have the next is it anchoring bias. Anchoring. It's like, I am an optimist. In my nature is to be optimistic. So what I do is, whatever news or whatever things I listen to, I come to a particular, I come to, I arrive at a conclusion which will underlie or which will justify my optimistic attitude, because I have anchored my opinion to a particular info what I have got. And I'll, whatever decision I arrive at, I'll be arriving at anchoring at that particular belief, saying that the price of a particular share will be going up. Somehow I have come to the conclusion that this is what is going to happen. Now, whatever decision I make regarding to the particular share will be anchored on that particular behalf. So that is anchoring or adjustment, or whatever further information I receive, I'll be adjusting it to my earlier, the primary information what I have collected. Now, one of the questions raised is, how can we connect investors' cognitive behavior to their emotional level? There are various methods where you can connect an investor's behavior with emotions. Lots of studies have been undergoing, completion on this particular study. It depends on what are the variables you take. What are the it's like investors in a particular area, or is it a particular section, or the investors who are investing in particular stocks or shares, depending, or how do their emotions. Each study will be completely different. Yes, you can obviously connect investors' behavior with their emotions. Lots of studies have been undergoing. You have to take emotions, the different types of emotions, as sub-variables, and you have to connect it. You have to form hypothesis, and you can conduct a study also. Definitely, you can connect it. Now, after anchoring, the next is cognitive dissonance. Now, cognitive dissonance. Cognitive means the reasoning judgments what you have formed. You have read about something, about a particular share, you have come to an understanding, and this is your belief. But then there comes a situation which is just opposite to what you have thought. You have been following a particular share for some time now, and you feel that the movement is up bullish. And you know that for one more week or 2 more weeks, with the help of this candlestick and the candle chart, you can predict the movement. You are anticipating a rise in the price. But suddenly, what happens? There is a fall. 2-3 days continuously, there has been a fall in the share price. Whereas your anticipation was the price will go up for some time. Now, what happens is you are in a dilemma. What to do with this particular share? There is a conflict. So that is dissonance. So that is cognitive dissonance. Whatever belief, what you have arrived at, whatever thoughts, whatever assumptions, whatever decisions you have arrived at, you find it a position where it is being contradicted, and you're not able to form any judgment. And in a hurry, you come to a conclusion, thereby it might be wrong, or occasionally it might be correct also. So that is cognitive dissonance. So likewise, you have many yes, you have availability bias. Okay, I've been informed that it's time for question answer session. So and finally, I'm just winding up this particular session, stating that a new emerging area. It's a new branch of behavioral finance called by the name neurofinance, where it is a study of economics, and you have psychology and neuroscience. It is how we study the human brain, how our human brain interprets or analyzes, evaluates a particular decision making, and what are the controlling factors which help us to arrive at a particular decision. Yes, I have stopped. Being punctual, I have stopped, and like how the moderator has said, it is time for the question answer session. Whatever questions I have been given in the chat box, I think I have explained it, answered your queries. You have any more? Please feel free to ask.
Thank you, ma'am. Thank you for the wonderful session, ma'am. Now, we are moving on to the question answer session of the webinar, and it will be handled by Swati S., Research Scholar, Department of Commerce, Government Arts College, Trivandrum. Participants can now raise your queries in the chat box. Audience are requested not to turn on your mic and ask the questions.
Thank you, Sophia. Am I audible?
Yes, Swati.
Good evening, everyone. So moving on to the question answer section. Actually, most of the questions have been answered by ma'am. So first, like Sonal Ahuja has asked, like, can you throw some light on future research area?
Definitely, you have, like what I said. See, behavioral finance is an area which is largely an intriguing area, actually, what I say. You have different dimensions, different point of view, which you can raise questions. It can be like how emotions affect individual investors, to how corporate build strategies. You have a vast arena. You have a very good excellent scope of research in this particular area. Like what I said, along with one of my research scholar, this time in 2021 in MG University, in the doctoral committee, I could see the order. I could see around 6 to 7 scholars have started their research in behavioral finance, and not one researcher or one scholar was asked to revise his objective because it clashed with another one. So at the same time, around 8, that is right in the year 2021. Prior to that and after that, you have many scholars pursuing. But even after that,
Ma'am? Excuse me, ma'am.
have I muted myself? No.
Yes, ma'am. Now you're audible, ma'am.
Okay. So it's a very vast area, and there are lots of research questions, research gaps to be filled in this particular area.
Okay, ma'am. There is another request. That is, can you add on more information on herdings?
Herd behavior.
Yes, ma'am. They have mentioned herding.
Okay. Herd behavior, it's like, have you ever seen the ducks, or in the case, how animals as a herd move? There is no need to bind them by a rope or anything like that, No one will deviate. And even if one, what do you say, the sheep deviates from the herd, there will be others who will poke them or push them into the group. And like I said earlier, man is a social animal, and we do not want to stand out. Obviously, if everybody is dressing in the same way, you will also tend to dress in the same. It's not like, or if you are exceptionally, your attention seeking, you will dress in a different way, which will make you stand out in the crowd. And as human beings, we do not want that. Same is the case of investors. You find that your investor, your friends, your circle of friends have been buying a particular share. You do not know anything about this particular share, how long the prices have been going up, till when it will go up, and how long it has been going up. You do not know anything about the company. But only the reason that your friends have invested in a particular share, you also tend to invest more, right? So that's a sort of herd behavior. And somebody
Ma'am,
wants
there
me to
is.
explain more about neurofinance, right, Swati?
Yes, ma'am, but we have time limit. So,
Okay.
audience, due to time limits, we are cutting short the Q&A section. Remaining queries can be forwarded to the mail ID, which will be posted in the chat box.
So thank you for your very patient listening. It was a wonderful experience for me also, because usually webinar sessions is always one-sided. I was having second thoughts. Should I have taken up this particular session? It's like the person talks, and talks, and at the question answer session there are no questions raised. But here I am perfectly happy right from the start of my session. It may be because my session was not too good, or there was not too much of information what I could give you more, or your level of information was much higher than from where I started. In that case, I ask sorry for that. Pardon me for that. But otherwise, it was a very good session. Thank you.
Thank you, ma'am. Thank you, Swati, for handling the session. Thank you, everyone, for your queries. Now, I invite Parvati R. Nair, Research Scholar, Department of Commerce, Government Arts College, Trivandrum, to deliver the vote of thanks.
Thank you, Sophia. Am I audible?
Yes, Parvati.
A warm and graceful good evening to our most valued resource person, Dr. Rajni ma'am, Head of the Department, Dr. Rabida ma'am, beloved participants and organizers. It is my privilege to have been asked to propose vote of thanks to this occasion. I, on behalf of Department of Commerce and the entire fraternity of the college, First of all, extend a very hearty vote of thanks to our resource person, Dr. Rajni B. Bhatt, Assistant Professor, the Cochin College, who spent time for us from her busy schedule. She enlightened us with her knowledge. Today's webinar was full of knowledge and new information. Next, I express my thanks to our principal, Dr. Sheila KL, in her absence for her guidance and support for the webinar. Further, a big thanks to our beloved head of the department, Dr. Rebida MV, who proposed a warm welcome to this occasion. Her support and encouragement for this program was immensible. I would like to thank all the faculty members, research guides, and research scholars of our college for their cooperation and support. Now, I express my heartfelt thanks to the organizing committee of the webinar for their willingness and involvement to take on the completion of the work beyond their comfort zone. Last but not the least, I express my thanks to all the participants for your presence and active participation throughout this program and making this webinar a success. We all thank you for being with us. Once again, thank you all. Thank you very much.
Thank you, Parvati. Once again, thank you everyone for your presence. Our next session will be on 7th May 2022 on the topic option trading by Rohit Sharma. The feedback link will be posted in the chat box. Do check that out. The link will be active for 20 minutes after the session, and we will see you all next Saturday. Thank you.